and welcome to the first edition of the Absa Business Connect Series for 2021. This marks the 12th edition of the series since its inception. As Absa, our brand promise and purpose is to help you find a way to get things done and to bring your possibilities to life. And that has been the very essence of this Absa Business Connect series. In previous editions that we had in 2020, my colleagues brought to you topics ranging from minimizing fraud risk to managing interest rate risk and foreign exchange risk in uncertain times. And to end the year in 2020, we brought you a session on guaranteed principal investment options here in Ghana. If for any reason you're unable to catch these sessions live, please do visit our Facebook page where the videos are still uploaded for your consumption. And for this particular session, if you have any questions or comments, please do leave them on our Facebook page, and we'll do well to respond to them after the presentation. Today's presentation is a very interesting one, and we'll be looking at the outlook for Ghana's economy in 2021, and it will be brought to you by our head of global market here at Absa Ghana, Mr. Kobla Nyalete.
Good morning to our clients, good morning to our friends, and Happy New Year. I bring you greetings from the management of Absa Bank Ghana Limited. We do hope that your year has started well. So today we want to share with you our thoughts, our views on how we see the Ghanaian economy in 2021. And we hope that despite the enormous challenges of 2020, you did your very best. Overall, I will be touching on the prospects for growth. I'll be touching on interest rates. I'll be touching on the foreign exchange rates. And I'll be touching on the exchange rates and probably give you a few forecasts as to how we see the key macroeconomic variables playing out this year. I would like to start by saying that COVID-19 still lurks around. Indeed, if we were to be having this conversation, say, 3-4 weeks ago, I'll be sounding a lot more upbeat than you will hear me today. However, we still expect the economy to recover this year. You may recall that last year was quite challenging, and indeed, when the Ghana Statistical Service does report finally how we did overall in terms of growth, we think it will be very, very weak. It will probably be around 1% thereabouts, because the economy technically went into recession in Q3, simply because of the effects of COVID-19. As I've said, COVID still lurks around, but to a very large extent, the whole world, globally, in Ghana, we found a way, to an extent, to manage our own lives and to carry out our business. As a result, as I speak today, for example, the chief probably measure of whether the economy is open or closed, we can probably use our schools as a barometer. And therefore, today, given that schools are open, it shows that we've learned quite adequately to keep going in spite of the challenges. As a result, we broadly expect a recovery this year, and we think the overall economy should be growing somewhere around 4% for 2021. And again, if you compare that to the 2020 predicted 1% growth, you will see that a recovery is probably in afoot. And for this year, we think services industry should begin to lead growth, as we probably saw in 2020. Pharmaceuticals, the coast should also be looking strong. We also expect financial sector to probably recover as well. Last year, when the pandemic kicked in, it did exert quite a bit of pressure across the financial sector. Banks, financial institutions had to help clients restructure, and therefore we expect the overall profitability, performance, banking, financial sector should be a bit pressured in 2020. But then into this year, they should rebound quite quite strongly. I will proceed to touch on inflation, as I've said earlier. And the reason why it is important for us to watch inflation is because it drives other variables, other very important variables. Therefore, for example, inflation feeds directly into interest rates. And inflation, as we know, is simply a measure of how prices are performing in the economy, how prices are rising. The central bank, who has the mandate to ensure price stability across the economy, has set a target for inflation, and they want it around 8% plus or minus 2. We ended the year slightly below 10, around 9.4, and for this year, we think the outlook for inflation is quite good. We see inflation probably not above 10% for most parts, for most part of this year. If you recall, last year at the onset of COVID, there was quite a huge increase in the price of food, and that drove inflation above the central bank's upper target of 10%. But as I said, November, December, we come in just below 10. And we think that the drivers of inflation, again, being food, being, for example, the prices of petroleum products and others, should broadly remain moderate. And as I said, that then bodes quite well for other variables like interest rates. And in interest rates, as you know, interest rate is the cost of funding, and is the price that businesses, individuals, households pay when they do borrow money. And here we would like to talk about the likely availability of credit, and then the price of that credit, the price being interest rates. Overall, if you look at the market for funds, if you look at the financial sector, which makes credit available, really, despite COVID, the market was quite liquid. Funds were available to businesses that needed to borrow throughout the large part of 2020. And we see those conditions really continuing into this year. The truth really is that because of COVID, the demand, and the need by individuals, households, businesses to really borrow wasn't that great in 2020. However, interventions from the government, intervention from the central bank did, lead to quite very, calm credit conditions. And therefore, the real businesses that needed money could actually have accessed it last year. And as I said, we think that should be the situation again, this year. Then the second part of that is, where do we see the price and therefore the interest rate? And again, if we agree, based on our outlook for interest rate, our outlook for inflation, which we think will not go really above 10%, for this year, it means that, the central bank that signals what interest rates should be doing in the economy. When they do pronounce on the policy rate, we think the policy rate, should be kept stable for the large part of this year. And therefore, from the central bank point of view, from the central bank's leading or indication, we do not expect them to signal that interest rates, should be going up. Additionally, we think the supply of money should also be adequate. And that in itself should lead to interest rates in Ghana definitely not looking upwards this year. We see the chance of quite a decline in interest rates because of other factors that may contribute to the supply of liquidity into the market. One example is this. You may know that Ghana actually participates in the international market to a very large extent. So, for example, when the government issues bonds, to raise funding to finance development work, external investors, people outside Ghana, are permitted to also come and buy those bonds. And we think that for this year, the activity of that group of investors will begin to have an impact on interest rates. Elections are over, in Ghana, and beginning January, what we're picking from the market is that investors are beginning to want to put the money, to use. Investors both in Ghana and outside. And the outside inflow of money is positive for the economy. As a result, in the market for bonds, for example, at the beginning of the year, so far this year, we've seen interest rate trend down by about 100 basis points. And as I speak to you, the signals in the market remain this positive. Very quickly to what we see about exchange rate. And again here, exchange rate is how the cedi is performing against the dollar, the euro, the pound. In Ghana, it is an important variable to watch because quite a significant part of economic activity of goods and services sold in Ghana have a certain import component. And therefore, if the currency depreciates, currency weakens, it means businesses have to pay more cedis, to access dollars, and therefore the price of goods may probably begin, to go up. Here again, happy to report that the country did very well in 2020, an election year. Cedi depreciating by less than 4% is relatively, it's a good performance, especially if you are to put that against previous years, especially previous, election years. The central bank, as I said earlier on, who is very interested and does play an active role in ensuring that prices are stable. And one of those prices is the exchange rate, did perform very well, last year. One introduction from the central bank did help the market, and that was a calendar, based approach using which the central bank provided hard currency, provided dollars to businesses, that did it. So, for example, today in Ghana, if you're a businessman and you have a need to pay for goods imported, say in 3 months' time, you could, through your bank, through us, through Absa, access the central bank window where you could buy dollars that will be delivered to you, say, in 3 months. That helped in 2 ways. One is that it provided extra dollars into the market. The second was that it began to provide some certainty to businesses. And as a result, for example, as I said, if you needed dollars in, say, 6 months, 3 months, 1 month, you could enter into contracts today that guarantee you the rate that you pay come the 1 month, come the 3 months. So that certainty also then begin to influence behavior, influence business activity, and led to the stability that we did see. In addition to that, various supports that the government received at the onset of COVID also did bring in a lot of hard currency. For this year, our view is that the cedi should perform creditably once more, because the central bank has actually increased this forward calendar-based FSLs that I speak about. They've increased it. And indeed, they've also biased the sale to respond to periods that we typically will see higher pressure on the currency. And that typically is Q1. So the central bank is looking to sell quite a big amount out of about 750 million allocated for the whole year, very early in the year. Additionally, related to the story I shared with you around non-resident investors, beginning to come into the market, beginning to come, into Ghana to buy Ghana investment. If somebody in the UK, US, want to buy a Ghanaian asset, for example, a Ghanaian bond, it means that that person must bring in hard currency. So, for example, an investor in the US interested in buying Ghana bonds must bring in dollars. There's no cedi in New York. So you bring in dollars, you sell for cedis, then you use the cedi to buy the bond. That activity in itself also is bringing dollars, into Ghana. And based on our outlook and based on our reading, we think that will, be a significant source of dollar flows into Ghana as well. And the final probably significant influence on the currency to mention for this year is that, again, Ghana is now also quite regular in the Eurobond market, where simply the central government goes to borrow hard currency, dollars, through the Eurobond market. For this year, the government has indicated that they may be looking to raise minimum of $3 billion. That will also be a significant inflow of hard currency. Finally, here as well, Ghana cocoa production annually brings in about $1 billion, and that will happen again this year. In addition to various other sources of inflows into Ghana. To summarize it really, despite COVID, on the macroeconomic side, on the key variable side of exchange rates, of interest rates, and of inflation, we see improving trends for 2021. And all of this should come together to provide businesses and households with a relatively improved environment in which they will be operating in this year. So, for example, outside of any exceptional event that may happen later this year, we do not see, for example, interest rate going up. And therefore, as a business, as a household, you can begin to plan with that. Another example is that, as I said, we see overall growth, overall activity across the economy beginning to rebound from predicted growth of about 1% in 2021. We think that we should be seeing growth close to 4%, if not a bit more. That means there will be a lot more activity, and therefore, as businesses as well, it is for us to be on the lookout for those opportunities and be ready ourselves, to recover some of the challenges, some of the losses probably that we may have suffered in 2020. So I'll probably, leave it here, and happy to now have a conversation. Happy, to hear what, our dear clients, our dear friends, think, and if there are any specific questions, we'll be happy to respond to same. Thank you very much.
Thank you, Kobla, for that. We'll take a short commercial break, after which we'll take the questions.
Everyday life, time no day believe me. No long things in my life, like I'm simple and easy. Everyday life, time no day believe me. Everyday life, time no day believe me. No long things in my life, like I'm simple and easy. Everyday life, time no day believe me.
Thank you, Kobla, again for that elaborate presentation. We have some questions here, and we'll be taking them. The first one is from Selasi Atipo. She's asking, how impactful will another lockdown be in light of what you have shared, especially on business owners and startups? How can a business weather the storm of such an impact?
No, thank you very much. So really, my starting point was that we expect recovery in 2021, but COVID does lurk around, and a lockdown will have significant impact. Our base scenario, is that we are unlikely to see, a lockdown as we saw probably in April last year. Our base scenario is that there may potentially be a few, restrictions, again. But the truth is that for the large part of this year and probably the first part of the year up to June, businesses will probably have to continue to operate quite significantly virtually, using digital platforms, finding ways to engage their customers outside of physical meetings, and I hope that a few businesses potentially would have perfected that way, of work, really from 2020. And indeed, that may actually be a feature that COVID lives with us for a very long time to come. Even if, in 2022 and beyond, the virtual way is looking like becoming a key feature. But to the question really is, as I said, base scenario, we do not expect a full lockdown as we saw. There may be some restrictions, and again, it's for all of us to read the trends. The trends being the number of active cases that we are seeing, and probably begin to prepare. Really, the other thing to note is that even if there isn't really a lockdown or these restrictions, some clients, some consumers may begin themselves to prefer that they are engaged in such impersonal ways, and therefore it is material, it is important that businesses begin to really beef up, invest more, and grow their capacity to deliver and interact with their clients in the virtual world.
Okay, so we have run out of time now, but please let's keep the conversation going. If you do have any pressing issues, comments, questions, please do drop them on our Facebook page, and we'll do well to answer them. As you know, our brand promise is to help you find a way to get things done. So please do reach out, and have a blessed day.